why I thought this question was useful was because I remembered it, and I thought it was a different style question. I think some guys, maybe if you've been to UJ, you would have seen it before. When I wrote it, I'd never seen a question style like this. So why I thought it was useful was, when you're going through your academics, and that disclosure is always a section of the lecture notes, and it could always come up in an exam or a tutorial question, but you don't really get taken through exactly what it means in terms of the disclosure. Also, you don't really get a lot of questions around disclosure, so you'll get it maybe here and there in different separate questions. Why I thought this one was really cool was because it was, I guess, disclosure focus for a 42-mark questions, but looking at different aspects. So, of course, over going through this question, you're not going to expect to see a similar question like this for this quantum of marks in future, and you never want to go through a tutorial and then hope that you get it again, because chances of that happening is very low. But why I thought it would be useful to go through this is because we can see the different disclosure requirements for like the different assets, the different liability, mainly from a balance sheet perspective. After going through this, later on after writing it, I thought it also looks like a quite a decent cheat sheet, you can call it, for what the solution is almost like a step-by-step guide on things that you should see when you're dealing with a specific asset or a specific liability. So going forward, I would even argue that you use the solution as your checklist or your guidelines in terms of deferred tax, in terms of impairment, in terms of financial instruments, what is required in terms of the disclosures, and then of course your illustrative examples gives you like a picture example of what it would look like in your balance sheet. Because I remember when I was studying, I didn't really, I remember the first time that I did disclosure, or they mentioned disclosure, it was in second year, we were covering inventory, and they mentioned that with inventory, you need to break down, what's your inventory, what's your consumables, what all the inventory balances. But from a picture perspective, or actually writing it down, how does a table fit together? What does it look like? And my lecturer at the time actually brought in a set of financial statements of a company that of course has a large balance of inventory. So and then now after studying and doing my articles, that's when I had the opportunity to actually see from a disclosure perspective what all this accounting really looks like. So it is quite helpful and quite useful to, for an example of the subject or the section that you're going through, to look at, financial statements of real life companies, because it shows you exactly like what the table needs to look like. It shows you exactly which section in the IFRS is basically requiring this disclosure, what it looks like, tax rate recons, for example, deferred tax examples, inventory, and then with the solution, we can actually see where, while they're explaining what is wrong, they're actually telling us what is right. So we'll always know, or we have an idea of what is the correct disclosure for all the balances. Cool. So without further ado, we're just going to go through the actual scenario. I'm not going to spend too much time reading through this, but one thing that was very interesting on this day was I read through the scenario. And while reading through the scenario, I wasn't really sure exactly where they were going with this in terms of the question. Then I got the question, and it was quite a eye-opener, quite a shock, because I'd never seen a question like that. And when I was reading the scenario, I hadn't even been thinking that way. So a lot of the things that I'd read, I hadn't maybe necessarily consumed it as I should have to be prepared to answer this question. So then I actually, after getting the required, I had to go back and spend a few more minutes in my actual work time, going through reading the scenario to actually identify and see which sort of things jumped out. From an exam technique perspective, how I answered this question, again, I never really got my marks for each section, so I don't know how well I answered this, but I passed at the end of the day, so that must be a good sign. But what I found useful was actually for the different assets, going into the actual standard in my IFRS, looking at what they explain within terms of disclosures, accounting policies, not just what they're saying about the disclosure, but also from an initial recognition, measurement, and so on, because that speaks to the accounting policies for each of the assets and liabilities. And then compared what the standard said to what the actual scenario said, and then it was almost like looking for keywords that jumped out that, no, this doesn't make sense, this doesn't look right, and then where I felt that it was incorrect, I of course wrote it down in my answer book. So going forward for you guys, when you're doing a disclosure style question, if you know the disclosures, off the top of your head, definitely use that as your guideline. But typically, we might not necessarily know that through and through. So, take the time to actually open your standard, look at what the disclosure says. Use that as a guideline in terms of the information you need to include in your answer book, and then as well opening up your illustrative example for a sort of picture-esque guideline in terms of what they're looking for. Cool. So this section was looking at the reporting for 2015. That's how long ago I wrote this. That's how long ago I did my CTA. They mentioned that of course they apply IFRS, so we have to use IFRS, but again, they need to really say that so that you can use your IFRS from a disclosure perspective. They had mentioned that performance in the plastic business was disappointing from 2014 to 2015 financial year. Now, performance being disappointing as just like written scenario doesn't, it should jump at, it doesn't mean that there should be impairment, but normally impairment happens when performance is not so great. It's either the asset performance is not so great or the business performance is not so great. That would lead to, these are sort of the indicators of impairment, if that makes sense. Then they mentioned that there was strong economic growth in the other companies, in the other countries. So other countries means consolidated financial statements, foreign groups. But then they say cash collection from customers, however, is problematic. So cash collection from customers. So your customers meant that we sold them, but they hadn't paid us in full, which means we have trade receivables. So cash collection becoming difficult means that we don't really have our trade receivable balance might not necessarily be the true reflection. We might be having our trade receivables at an amount higher than what it should be, what it can be recovered at. So AKA expected credit losses, in other words, impairment. And then net losses, of course, another impairment indicator. Subsidiaries had assessed tax losses. So when you have an assessed tax loss from a tax perspective, it often means that you're not paying tax that year. But if you can roll that tax forward, it means it reduces your taxable income for the next year, which means you will pay less tax in the next year. But we know that from a tax perspective, there might be some ring fence rules, and we might not always, if I remember correctly from tax, you're not going to be able to roll forward or use your assessed tax losses in the future if there's no indicator that you will make tax losses in the future. Right, so SARS basically allows you to use this tax losses that you have this year against your future taxable income next year, because they would have taxed you next year, but now because you have tax losses, it reduces that. But they're only going to allow you to do that if you can show that next year, chances are you're going to have taxable income against this. Now, from an accounting perspective, assessed tax losses, based on that explanation, usually results in a deferred tax asset. But you can only recognize that deferred tax asset if you can prove that in the future you're going to make, taxable temporary differences, right? So essentially from an accounting perspective, we can only recognize assets if we can prove that in the future we're going to have liabilities that we can offset against that. And then it's possible in accounting, these tax losses or just deferred tax asset can be limited to a certain amount. So that's the one thing. And then the second thing from a tax perspective, but now also accounting perspective, is that if the subsidiaries have the tax losses, the question is, can we offset because you can only offset your deferred tax balances between maybe, you know, industries or businesses if you have the, what's the word, the idea or the plan to settle these tax, from a tax perspective, these taxable income and taxable losses on a net basis. That usually happens if you have divisions, all part of the same group, all part of the same company, or if you have subsidiaries, but they may be all registered under the same tax number, for example. But if you've got subsidiaries in different countries, those subsidiaries would make tax losses, therefore have deferred tax assets in their respective countries. When you consolidate and you group, you show it from the position of what it looks like from South Africa. But from a tax perspective, you'll have a tax authority here in South Africa and you'll have tax authorities in other countries. So you wouldn't be able to net off the actual tax expenses or the taxable liabilities to those countries. So that would limit you from offsetting your deferred tax assets and your deferred tax liabilities against each other in your financial statements, because they're not basically going to be submitted to the same reporting entities and the same taxable tax entities. Right, goodwill. So the goodwill relates to both the plastic and paper businesses. We must remember that the plastic, I think they said, plastic business had a disappointing year. Disappointing year means that the value of that business might not be as accurate as it was when we acquired it. Goodwill is linked to the value of that business when we acquired it. So if it's doing poorly, it might be an indicator of goodwill being impaired. Investor downgrade, also another indicator maybe of impairment. And then early adoption of IFRS 9. So what does that mean for us here? Well, what it meant for me at the time was early adoption meant, okay, I can actually use IFRS 9 in terms of my standards in the reporting. For you guys, I think IFRS 9 has already been fully adopted by most of the companies you'll be reporting. So you won't even be looking at this early adoption anymore. But I suppose in future, if there's another standard that comes out, I think I don't know if it's 14 or 17, that's insurance, you know, early adoption would mean that it's applicable when you're doing your review of those financial statements, right? So from a reading time, that's kind of what I'm thinking, or I should have been thinking when I was writing this exam. What is the relevance of all this information, right? They're not giving this information just to use up my reading time. They're giving me this information because it means something in terms of the questions that I'm going to be answering in the future. So things like goodwill, now I'm thinking goodwill in terms of the calculation, but goodwill in terms of the impairment. I'm also thinking groups. I'm thinking indicators of impairment, so I might need to do a calculation. I might need to do some disclosure. I might need to do some journal entries. Right. So then they gave us financial statements. So as a rule of thumb with your financial statements, just as a quick, you know, ARP, if you want to use like audit speak, you want to do like a quick analysis. So typically you expect your asset balances to more or less increase. If there are big increases, you want to know why. If there are decreases, you want to think why. Goodwill are one of those balances that you expect to stay the same. Right? So if it stays the same, it meant that the business was fine, we didn't need to impair it. If it increases, it meant that we most likely acquired another entity and then we added the goodwill. If it decreases, it meant that we had impairment or we sold the subsidiary and we no longer have goodwill. So if it stays the same here, we're thinking, okay, the business was fine, right? We didn't acquire any more. We didn't maybe sell any, we didn't acquire any subsidiaries a subsidiary. We didn't sell any subsidiaries. But if it stays the same, it also means that we shouldn't have impairment. But if there are indicators of impairment, i.e. the businesses have been struggling, then we expect this amount to be decreasing. It stayed the same, so that might be some concern. Investment in associate, great. So it's increasing. That meant that looks like the associate is actually doing well. We are having earnings from associate, so it's going up. Loans to associate. So the thing with the loans to associate is that you can have, of course, loans to your associate. You can have loans to subsidiaries. Because it's associate, we won't necessarily need to eliminate because we don't control them. However, the thing you also need to consider with associates is if there's loans to the associate, right? And as you can see here, this balance is not increasing or decreasing. A loan we would expect to decrease over time because we may be expecting some payments to come in. If it's staying the same, and it implies that there's no payment terms, i.e. they're not going to pay us back in any time soon, or there isn't a redemption date, then this loan is less of a, I guess, debt to the associate, and it's more of an equity sort of contribution or an investment, because it shares a similar characteristic to an equity. If you give out a loan to an associate but you don't really specify the date that you need to pay me back and how much interest you need to pay me back on an annual, quarterly or monthly basis, then it's how different is that from them just buying share capital and then getting dividends whenever they receive dividends and getting the money back and getting maybe a share buyback, or them selling the investment in share capital when they decide to get that investment in share capital. Is that making sense? Cool, yeah, just stop me if it's not making sense. Okay, unlisted investments, right? So unlisted investment, implies we've got, we bought shares in another company, right? Now, by virtue of this being in, but it's consolidated financial statements, it meant that we don't have control, and it's not an investment in associates, so we know that we don't have significant influence. So this tells me that we've invested in shares in a company, we bought shares in a company, but it's not significant influence or control. Right? It's unlisted, so that means we can't go to the JSE to check the fair value of it going up or down. Okay, also I should emphasize that it is shares. Now remember, if it's shares, right, from an IFRS 9 perspective, that means we're not going to expect any amortized cost unless they're telling us it's maybe preference shares with mandatory redeemable rights, and we're hoping to get interest and our capital amount back. But if it's unlisted investment, we're implying that it's shares. So the only the options that we have is fair value through profit and loss or fair value through OCI. Fair value through OCI should be irrevocably elected, and they need to give us some sort of indication that that's the case. But now, because it's share investment, we expect that this number should increase or decrease, because the fair value of these shares, even though it's not listed and it's not going to be easily observable on some sort of ticker or some sort of stock exchange, we expect this amount to change, because every single year, even if you're going to manually value it, you're going to value that amount on different inputs, because the inputs are going to change every single year. So this really shouldn't really stay the same. Deferred tax asset, cool. We would expect to see a deferred tax asset because they mentioned that they have assessed tax losses. They show here that they didn't have anything last year, so that means it was a new balance. All right. Inventory. Okay. Now with inventory, you expected, I think, from a variance analysis, like just analyzing financial statements, you would maybe want to see the inventory decreasing, because then that shows that people are buying your inventory. If you're seeing it increased by this much, it means two things. We either bought a lot of inventory and then we in anticipation for what's going to happen in the next few years, but this has increased by almost like it's increased by 400%, right? Now that could tell me that, okay, I bought more inventory, and then the inventory that I got, I didn't sell it in enough time. Now, if I haven't been able to sell my inventory, why haven't I been able to sell my inventory? Is it because this inventory is obsolete? If this inventory is obsolete, that means I need to look at what is its net realizable value, which is going to be an indicator of impairment for that inventory. So we need to ask the question, have we impaired this inventory? A large inventory balance is not always a good sign, because it means that we have too much inventory in stock, not selling it enough time, inventory can get obsolete. Trade receivables, again, trade receivables, you would want this balance to decrease. Decreasing meaning that we're getting our cash coming in. They say that cash collection is a problem, so it would make sense why this balance is maybe increasing. Plus, we're also making cash credit sales, which would imply why this balance is increasing. But now again, this balance, you could say it's increased by almost 50%. So that could pose a problem. Now we need to ask ourselves, is this balance actually sitting at its the correct fair value? Should we have expected credit losses on this amount? cash and cash equivalents. Cool, increasing balance. That's usually a good sign, especially if the business hasn't been doing too well. All right, share capital. Share capital, you don't really see too much movement unless there's been share buybacks or there's issued shares. And then retained earnings. Cool, we've seen that it's decreased a bit. They said that the business has been struggling. Foreign currency translation, that tells us that okay, we can expect to have foreign currency translations because we have groups in another country, so we would expect to see that. Bond equity, not too sure what bond equity is. That would be very interesting. They haven't really mentioned anything around what that is. I would assume bonds to either be some sort of asset, but if it's financing equity and liability, so maybe more of a bond liability. Of course, unless it's maybe a compound financial instrument. So that's bond, like you have a debt instrument with an option to convert into equity. So normally when you have compound financial instruments, we have to separate what is equity, what is liability, and then the equity balance usually stays pretty flat year on year until we decide whether the guys are going to convert to the bondholders are going to convert or not. Cool. Then we have our bond liabilities. We're seeing that it's decreasing, so we're most likely paying off. What we want to consider about this bond liability, specifically with IFRS 9, is what are we going to classify this bond liabilities? And similarly, so with these assets, right? IFRS 9, what are we classifying it? Our options are amortized costs. We have fair value through profit and loss, and we have fair value through OCI, right? And then from a IFRS 9 perspective, the business model of this business, the business model that this company chooses, is going to be the driving force to classify it. Similarly, so with what they hope to achieve with the liabilities, that would drive the classification. Right, then deferred tax liabilities, we can see that they had a liability, now they have a zero balance. Here they had a zero balance, now they have a positive balance. So this is implying to me that these are tax assets. We had deferred tax assets, we had deferred tax liabilities, we've offset them. Now, if you're a separate company and you have divisions, and divisions make tax losses, and you have tax losses in one division and you have taxable income in another division, because we are of the same company, you can offset. But here it will be difficult for a consolidated group to offset because we have most likely tax losses coming from different entities, and we're not always allowed to offset them from each other. So that might actually be a problem. And then trade and other payables, this is increased by quite a bit. So the question is, what are we including in these trade and other payables? Then they said these notes have been prepared but have been omitted from the extracts provided below and therefore can be accepted as being correct. So here they're telling us that all these things with the stars notes are fine, because as we know, the required is asking us to comment on what was right or wrong with this disclosure. If they hadn't told us this, we would have to ask, do you have this section? Can we see it? All right, significant. So this accounting policy section, it's always been in our disclosure, but I never really knew what it meant until I was actually doing my articles, and you're actually seeing companies, they have a whole extract explaining what are the significant significant judgment and estimations of uncertainty that has impacted this business. Now they've mentioned that it's impairment, the main one, but it wouldn't only be impairment, because we know we have unlisted shares. We've got unlisted shares, and those unlisted shares are going to be based on are going to be based on estimates, because it's not on the JSE, and we can't take, because it's not on the JSE, normally we take the JSE's fair value as law, but now here we need to estimate what our fair value is going to be, and we're going to present that, and then that's going to influence the use of the financial statements, because if the company has made the wrong estimates, it's going to significantly influence the balance that we show, and it might make the company's total assets be better or worse depending on on the estimates that they've chosen. And they've explained to us how they've done the impairment testing. So in this position, you should be thinking, this is how they've done the impairment testing. I need to go into my notes. I need to go into my standard and check if they've actually used the right, determinable, the individual assets, the determinable base, the discounting amount, the indicators that have justified doing an impairment test. And also impairment tests, why are they only focusing on CGUs? Are there maybe any other assets that need to be impaired, right? Then they tell us the classification of financial assets, and they say that all the financial assets are classified here. But what's important is that all these classifications, we would expect to see assets that are classified here. So if we don't see any assets that are classified using these buckets, then it's irrelevant to include this information. Then they've explained, okay, business model, that's great. And then they've explained, okay, business model for fair value through OCI, hold to sell. They've explained the business model for financial liabilities. They've told us that the unlisted investment, how they've calculated it, PE valuation, that's the estimate. Similar listed company. Now you are allowed to use similar listed company, but remember now, fair value hierarchy, that's IFRS 13 category. What does level 1 mean? Level 1 means observable input. Level 2 means of some of estimate and some observable. Level 3 means fully unobservable. Of course, lots of estimates. So if they're saying level 2, they need to explain to us what are the observable inputs, because they're basically using a mix. If there's no observable inputs, it can't be level 2. Right, deferred tax, asset, and liabilities. They've explained to us basically what are the disclosures that they're using for deferred tax. We need to now go into IAS 12 and see if there's any disclosures that might be applicable to this specific company that they've included. The loan to associate, they're speaking about the 25 million provided 3 years ago. Loan pays no interest, no repayable on demand. In the view, 0 interest on loan. The loan is accounted at historical cost. Now, here it would be tricky because IFRS 9 doesn't really speak too much about this unless it's been, classified as IFRS 9. But then I think it's IAS 28, which speaks to associates. It has a section that talks about what happens with loans to associates that are not they're not repayable on a specific date. They don't really have interest. It will say that that these loans should be treated more like equity than actually debt. Financial risk disclosures. So this again, you would need to go into your standard, because personally, when I was studying, I didn't deal too much about this. So I would look at this and read, how would I even know if it's right or wrong? So you would have to go into your standard and see, is it worth it? Is the information correct or not? So with disclosure, like I do emphasize, use your standards, because that's most likely the easiest way that you can see what you need to put down if you're reviewing it, or what needs to be right, what is right, what is wrong. Business only has one segment, namely the packaging segment, and therefore does not prepare. Is that correct from a segmental reporting? Because that you can report based on geography, you can report based on type of business. We know that they have different entities, so that's already in different geographies. So would it be correct, and would it be useful information just to put it under one segment? Contingent liabilities, events after the reporting date, so that's going to be important. Have they treated this event of the reporting date correctly? We would need to look at the dates when we got it, and then of course, is it a contingent liability, right? Because it sounds like they've agreed to pay the 20 million. So should it be a contingent liability? Should it be a provision? Should it be an actual outright loan? And therefore, it's important to know what are the differences between what makes something a contingent liability. Well, there's some sort of possibility, and there's either uncertainty in the amount that needs to be paid, in terms of the possibility of that amount being paid, or the possibility of the timing of that amount. Or is it a probability? So we know it's going to be paid, but we don't know when it's going to be paid, or we don't know what amount it's going to be paid. And then if it's just a full-blown liability, well, we know all the information, we know when it must be paid, we know how much must be paid, and then we just recognize it.